Forget what you think you know about market crashes. Forget the images of Lehman Brothers collapsing or bankers in suits carrying cardboard boxes. Everyone is preparing to fight the last war, watching for the ghosts of 2008, but they're looking in the wrong direction. Imagine global markets get rocked by a major policy shock. Analysts on TV would point to the usual culprits: geopolitical tensions, trade wars, and policy missteps. And they'd be right. But they'd also be missing the bigger picture, because beneath the surface of a loud, obvious crisis, a second, silent crisis has been spreading. It's not about the value of assets. It's about the identity of the people who own them. A digital poison has been seeping into the veins of the financial system, and it's making it impossible to answer one simple question: who can you trust? The real crash, the one that could change the rules of the game, is a crisis of identity, and the foundations for it are being laid right now. For over a decade, the financial world has been haunted by the memory of 2008. That crisis was, at its core, a crisis of solvency and credit. It was born from a tangible problem: bad loans packaged into complex securities. When homeowners defaulted, the securities became toxic, and the banks holding them went down. It was a chain reaction of bad debt. The system froze because the money, basically, was gone, built on a foundation of bad bets. Any future crisis triggered by a political decision, like new tariffs that spark fears of a global trade war, would feel different but still follow a recognizable script. It would be a classic crisis of confidence in economic policy and future corporate earnings. It wouldn't be about hidden toxic assets. It would be about the visible, top-down threat of an economic slowdown. This is the narrative you'll hear everywhere. It's a story of overvalued stocks, interest rates, and geopolitics. And while all of that is real, it's also a powerful misdirection. It focuses all our attention on the traditional levers of power: governments, central banks, and corporate earnings. It makes us believe that if we just fix the policies, the system will return to normal. But what if the system's foundation is rotting from the inside out? What if the problem isn't the value of the assets, but the very identity of the people trading them? This is the new reality the mainstream narrative ignores. The 2008 crisis was about a failure of credit. A future policy-driven crash would be about a failure of policy. The crisis that is silently building is about a failure of trust, enabled by technology that is moving faster than our ability to control it. The source of the shock has changed. The crash we can see might just be hiding a more dangerous one that we can't. The real threat isn't coming from Wall Street's trading floors or Washington's policy debates. It's coming from the servers and algorithms that run our world. The threat is AI-powered identity fraud. This isn't about stolen credit cards or phishing emails with bad grammar. Today we're dealing with something new: generative AI as a weapon. This technology has democratized the ability to create hyper-realistic deepfakes, synthetic identities, and perfectly cloned voices. Fraud has always existed, but now the tools have fundamentally changed. Imagine a bank that can no longer tell a real customer from a perfect digital ghost created by AI. Who do they lend to? Whose transaction do they approve? This isn't science fiction. In early 2024, a finance worker at a multinational firm in Hong Kong was tricked into transferring about $25.6 million after attending a video conference with people he thought were his colleagues. The CFO, the other executives, every single one was a deep fake. The victim was the only real person in the meeting. That wasn't just fraud. It was a milestone. It was the moment synthetic fraud graduated from a fringe experiment to a weapon capable of major corporate theft. This is the silent crisis. It doesn't appear on a balance sheet or in inflation data. It's an operational shock, not a credit shock. While analysts watch stock market swings, criminals are weaponizing a technology that fundamentally undermines the bedrock of all finance: proof of identity. The growth is staggering. Some security firms have reported shocking increases in deepfake-related fraud, with one analysis for North America noting a 1,740% surge between 2022 and 2023. Today's scams don't always come with typos. They can come with perfect grammar, cloned voices, and videos of people who don't exist. This is the new kind of systemic risk. The 2008 crisis was a failure of value. This is a failure of verification. When verification fails, trust collapses. And when trust collapses, the whole system can grind to a halt. Not because the money is gone, but because no one knows who to send it to. So how does this silent crisis actually work? It operates through 4 interconnected mechanisms that are rapidly scaling, creating a perfect storm. First is the technology, generative AI and deepfakes. Criminals can now produce multimodal synthetic identities. This isn't just a fake profile picture. It's a realistic video, a cloned voice, and forged digital documents that look indistinguishable from the real thing. It's become so serious that the U.S. Treasury's Financial Crimes Enforcement Network, or FinCEN, issued an alert in November 2024 to warn financial institutions about fraud schemes using generative AI. This technology directly attacks the Know Your Customer, KYC checks, that are the first line of defense for any bank. Second is the method, synthetic identity and account takeover. Instead of just stealing one person's identity, criminals use AI to create Frankenstein identities, combining real, stolen data with fabricated information. These synthetic identities are used to open new accounts, build a credit history, and then bust out by maxing out huge lines of credit before vanishing. According to a 2025 report from the fraud detection company Verif, about 1 in every 20 verification attempts in the financial services sector was flagged as fraudulent in 2024. Third is the accelerator, faster payment systems. In the old system, a fraudulent wire transfer might take hours or days to clear, leaving a window to reverse it. With today's real-time payment rails, that window has vanished. A successful scam can result in an irreversible loss in seconds. The speed of the system has become a vulnerability. Fourth is the business model, fraud as a service. These advanced criminal tools are no longer exclusive to sophisticated hackers. They are packaged and sold on dark web marketplaces, particularly on platforms like Telegram. One firm, Point Predictive, monitored Telegram channels and saw messages related to AI and deepfakes grow from 47,000 in 2023 to over 350,000 in 2024, a more than 7-fold increase. This isn't a handful of hackers, it's a booming, scalable, underground industry. These 4 forces are creating a feedback loop. More accessible AI tools lead to more sophisticated attacks, which are amplified by faster payment systems, leading to bigger losses. Some projections, like one from Deloitte, show AI-facilitated fraud losses in the US could rise from around $12 billion in 2023 to about $40 billion by 2027. It's a silent, exponential threat that erodes trust at every level. How could this escalating fraud translate into a full-blown market crisis? The real danger is how this crisis of identity could change behavior across the entire financial network. It could trigger a domino effect built not on insolvency, but on rational paranoia. The first domino could be interbank trust. Banks lend to each other constantly. It's the plumbing that keeps the system liquid. But what happens when a major bank is publicly hit by a massive deepfake heist, like the $25.6 million Arup case? Other banks might hesitate. They might question the security of their counterparties. Is the person on the other end of that transfer request real? That hesitation is how credit can freeze. It would be a modern-day bank run, where banks refuse to lend to each other because they can't be sure who they're dealing with. The second domino is the credit market. As banks become more paranoid about fraud, they will inevitably tighten lending standards. The cost of verifying identity could skyrocket, and the risk of getting it wrong becomes catastrophic. This could lead to a credit contraction. Businesses that rely on credit for daily operations could find their access choked off. The economy could slow, not from a lack of capital, but from a breakdown in its secure distribution. The third domino is public confidence. Every headline about a multi-million-dollar deepfake scam erodes trust in digital banking. Some surveys have found that a large majority of consumers have been targeted by scam attempts. As attacks become more common, people might question the safety of the entire digital banking ecosystem. This could lead to a slow withdrawal of funds from more vulnerable platforms, creating liquidity problems for institutions that rely on digital deposits. The final domino could be a regulatory shock. As losses mount, governments will be forced to act. They would likely impose sweeping, heavy-handed regulations. This could include new liability rules or mandatory holds on large transfers. While well-intentioned, a sudden regulatory overreaction could paralyze payment systems and create its own economic shockwave, amplifying the crisis instead of containing it. This is the pathway to a systemic crisis that doesn't follow the 2008 playbook. It's a crisis where the system could seize up, not from a lack of money, but from a lack of trust. It's a world where every transaction carries an invisible risk, and the default response becomes no. CTA. The financial world is entering a new era, defined by a technological arms race. While criminals weaponize AI, banks are deploying their own AI for defense. Many surveys show a large majority of financial institutions are now using AI to fight fraud, analyzing user behavior and detecting anomalies in real time. They are fighting fire with fire. But this is not a war that can be won by institutions alone. Understanding this new landscape is the most critical step you can take. If you want to stay ahead of these powerful new trends and understand the hidden risks in our economy, make sure you subscribe to this channel and hit the notification bell. The nature of financial risk is changing faster than ever, and we'll be here to break it down for you. Share this video with someone who still thinks the next crash will look like the last one. For months, all eyes have been on market chaos sparked by tariffs and trade wars. That kind of event is a storm we have seen before. It follows the old rules of economics and politics. The far greater danger is the one that doesn't follow any rules we recognize. The silent crisis of AI-driven identity fraud represents a fundamental change in the nature of financial risk. We've moved from a world where risk was on a balance sheet to one where it's embedded in every digital interaction. The comparison to 2008 is not just unhelpful. It's dangerous because it blinds us to the real vulnerability. The system's failure mode has shifted from insolvency to potential failures of identity and trust, amplified by AI and real-time payments. The market volatility we see from policy and politics is simply a tremor. It's a stress test that reveals the cracks in the foundation. But the true systemic event won't be triggered by bad loans or bad policy. It will be triggered when the trust that holds our digital economy together finally evaporates. When we can no longer be sure that the person on the other end of the line is real, the system as we know it will cease to function. This isn't a prediction for the distant future. The pieces are already in place. The crisis isn't coming. The conditions for it are already here, silently rewriting the rules of money and power.